Chapter 1. Somewhere out there right now, there's a trader staring at a chart with a brain that could probably design a skyscraper from scratch. A trader who can explain macroeconomics in detail, who understands probability, who can break down market structure candle by candle and tell you exactly why price moved the way it moved. A trader who sees patterns before other people even realize there's a pattern forming. And yet somehow that same trader keeps losing money. Losing money in a way that feels insulting, in a way that makes you question your own competence, in a way that makes you feel like the market is personally exposing you. If you've ever felt that contradiction where your intelligence is high, but your account balance doesn't reflect it, you're not alone. And more importantly, you're not broken. Trading is one of the only environments where intelligence does not automatically convert into results. That realization is especially painful for someone who has spent their entire life being rewarded for being smart. In school, intelligence brought recognition. In work, intelligence brought opportunity. In conversations, intelligence brought respect. Preparation usually led to performance. Study led to outcomes. Effort led to measurable progress. Trading interrupts that pattern. It introduces an environment where you can understand deeply and still experience loss. It introduces a space where explanation does not equal control. That disconnect is what destabilizes the intelligent trader. There's a trader I knew named Tyler who lived inside that exact contradiction. Tyler had always been the sharp one in every room. He processed information quickly. He could pick up new systems fast. He was confident in a quiet way, the kind of confidence that comes from competence rather than noise. When he discovered trading, he approached it like an academic discipline. He researched relentlessly. He built spreadsheets. He backtested. He refined entries. He categorized market conditions. His notes were meticulous. His understanding was solid. On paper, he looked like someone destined to dominate the charts. Then he started trading live. And that's when something unfamiliar surfaced. The market introduced him to uncertainty with financial consequences attached. When his first real losing streak hit, he didn't collapse emotionally in an obvious way. There were no dramatic outbursts. There was no visible panic. What shifted was subtle. His decision speed changed. His patience narrowed. His standards quietly adjusted. He didn't think he was reacting emotionally. He believed he was adapting. That belief is where the trap began. Trading doesn't expose intelligence gaps as much as it exposes behavioral gaps. Tyler wasn't struggling to understand the market. He was struggling to tolerate what it felt like when the market didn't reward him immediately. What makes this particularly difficult for intelligent traders is that the mind is extremely good at creating explanations for emotional shifts. After a loss, Tyler would feel a tightening in his chest and an urge to lock in. He interpreted that as focus. After missing a trade, he would feel irritation and call it analysis. After a winning streak, he would feel elevated and label it momentum. In reality, his internal state was fluctuating, and those fluctuations were subtly influencing execution. A small change in timing, a slightly wider stop, a quicker trigger, a trade taken just outside the rules but justified through reasoning. The market doesn't require large emotional explosions to create damage. It only requires small deviations repeated consistently. Tyler's intelligence gave him the ability to justify every deviation. That ability became both his advantage and his vulnerability. Intelligent traders often assume that if they understand enough, they can manage outcomes. Trading challenges that assumption. You can understand thoroughly and still face randomness. That friction feels deeply personal when your identity has been built around competence. Tyler didn't lack skill. He lacked comfort with uncertainty, and that discomfort expressed itself in behavior long before he consciously acknowledged it. Chapter 2. Tyler didn't realize when trading stopped being about money and started being about identity. That shift never announces itself loudly. It happens quietly, almost politely, slipping underneath logic until it becomes the hidden motivation behind decisions. In the beginning, every trade felt like a test of skill. That made sense to him. Skill had always produced results in every other area of his life. When he studied harder, grades improved. When he practiced something long enough, performance followed. Progress had always been linear enough to feel predictable. Trading introduced a different rhythm. Some days he executed perfectly and still lost. Some days he hesitated and the market rewarded him anyway. Outcomes refused to align cleanly with effort. That inconsistency created tension he couldn't name at first. He told himself he needed refinement, better confirmation, sharper timing, more data. His solution to discomfort was always more understanding, so he doubled down on analysis. He added layers to his process. He watched additional markets. He compared correlations. He built scenarios before the session even opened. From the outside, it looked disciplined. Internally, it was anxiety wearing a professional suit. The real turning point came during a week where nothing dramatic happened. No catastrophic losses. No blown account. Just a slow bleed of small red trades, each one within plan, each one technically acceptable. That's what bothered him the most. If mistakes had been obvious, correction would have felt simple. Instead, everything looked reasonable. His notes said execution was fine. His entries followed criteria. His stops were placed correctly. Yet the account drifted downward anyway. Every evening he reviewed charts looking for the missing piece. Every morning he returned convinced he had found it. Each adjustment felt intelligent. Each adjustment felt responsible. And every adjustment quietly changed the structure he originally trusted. He didn't see that he was negotiating with discomfort. Losses created a feeling he wanted resolved quickly. Intelligence provided endless tools to justify resolution. The mind is incredibly creative when it wants relief. During that period, Tyler began entering trades earlier than usual. The logic sounded strong. He told himself he was improving efficiency. In reality, he was trying to avoid the discomfort of watching a setup move without him. After a winning day, he sometimes increased size slightly. He described it as capitalizing on favorable conditions. The deeper truth was harder to admit. Winning restored his sense of competence, and he wanted to extend that feeling. When losses followed, he tightened criteria. He called it risk awareness. Underneath it lived hesitation. None of these behaviors felt reckless. That's why they were dangerous. Intelligent traders rarely sabotage themselves loudly. The sabotage happens through reasoning that sounds sophisticated enough to feel correct. One afternoon, he closed a trade early even though the target had not been reached. Price had barely moved against him. There was no rule violation. Still, something inside him wanted closure. He watched the chart afterward as price eventually reached the level he originally planned for. The profit he missed bothered him less than the realization that he hadn't trusted himself long enough to stay in. That moment stayed with him longer than any large loss ever had. He began noticing how often his decisions were shaped by a need to restore emotional balance. After losses, he wanted reassurance. After wins, he wanted continuation. The market became a mirror reflecting his internal fluctuations back at him. Trading has a way of revealing how deeply people associate competence with certainty. Tyler believed that a skilled trader should feel confident entering positions. He believed clarity should accompany execution. When doubt appeared, he interpreted it as a signal something was wrong. That interpretation pushed him into constant adjustment. What he didn't understand yet was that uncertainty never leaves trading completely. Waiting for emotional certainty before acting meant opportunities passed. Acting impulsively to escape doubt created different problems. His intelligence searched endlessly for a perfect internal state before execution. The market continued moving regardless of whether he felt ready. He started noticing another pattern during quiet sessions when price barely moved. Those were the hardest days for him. Silence felt heavy. Watching charts without action created restlessness he struggled to sit with. He found himself scanning lower time frames, searching for reasons to participate. Activity felt productive. Stillness felt like wasted potential. That reaction surprised him because he had always considered himself patient. Outside trading, he could study for hours. He could work long stretches without distraction. Trading revealed a different form of waiting. Waiting while risk and uncertainty hovered nearby felt entirely different from waiting in comfort. He realized he wasn't just trading setups. He was managing sensations, boredom, relief, frustration, anticipation. Every one of them tried to influence timing. The realization arrived slowly rather than as a dramatic breakthrough. Tyler began to suspect that the market wasn't challenging his intelligence at all. It was challenging his relationship with uncertainty. Every adjustment he made after discomfort created inconsistency. Every attempt to restore emotional balance interfered with repetition. The edge he had researched required volume to express itself. Volume required steadiness. Steadiness required something he had never needed before: emotional endurance without immediate feedback. That requirement felt unfamiliar. In school, feedback came quickly. In work, feedback came through results. Trading stretched feedback across sequences, sometimes across months. His intelligence wanted answers sooner. The market refused to provide them on demand. He didn't suddenly become calm or enlightened after realizing this. Awareness rarely fixes behavior immediately. What changed first was observation. He started noticing urges before acting on them. The urge to move stops. The urge to enter early. The urge to chase after missing a move. He still felt them. The difference was he could see them forming. That space between feeling and action was small at first, almost invisible. Yet inside that space lived the beginning of discipline. And for the first time since he began trading, Tyler sensed that the real work ahead had less to do with finding a better system and more to do with becoming someone capable of executing the one he already had. Chapter 3. Tyler always believed progress should feel obvious. That belief followed him into trading without question, because it had never betrayed him before. Improvement had always produced visible reinforcement. When he learned a language, conversations became easier. When he trained physically, strength increased. When he studied complex subjects, understanding accumulated in ways he could measure. Trading refused to cooperate with that expectation. Weeks passed where effort increased and results barely moved. Some periods even moved backward. The charts did not acknowledge how prepared he felt. The market never congratulated him for discipline. Execution happened in silence, and silence left room for doubt to grow. During one stretch, Tyler experienced what many traders quietly endure but rarely discuss. His losses became smaller. His mistakes became fewer. His account, however, barely changed. He hovered around the same balance for months. No dramatic drawdowns, no impressive growth either. Every session felt like walking on a treadmill. He kept moving, yet never arrived anywhere new. That kind of stagnation created a different type of pressure. Catastrophic failure at least gives direction. Flat performance leaves questions hanging in the air. He began wondering whether he had misunderstood something fundamental. Maybe the strategy lacked edge. Maybe market conditions had changed. Maybe success required an insight he had not discovered yet. His mind searched constantly for the missing explanation. This was the period where intelligence becomes especially dangerous. Tyler started analyzing trades beyond usefulness. He replayed entries repeatedly, zooming into smaller time frames looking for subtle confirmations, he might add. He reviewed macroeconomic events, searching for hidden correlations. He compared his performance to traders online who seemed to progress faster. Each comparison added weight to decisions that used to feel simple. Execution slowed. Hesitation increased. Even valid setups felt heavier because they now carried layers of additional thinking. The irony escaped him at first. The more information he gathered, the harder it became to act. Knowledge multiplied scenarios faster than confidence could keep up. One afternoon provided a moment he couldn't ignore. A clean setup appeared exactly as defined in his plan. Structure aligned, risk parameters were clear, volume confirmed participation. Everything matched. He watched it form and felt hesitation rise anyway. His mind produced possibilities instantly. News later in the day, a higher time frame level nearby, a correlation chart suggesting caution. None of these invalidated the setup. They simply existed. He waited. Price moved without him. The trade reached target hours later. Watching it unfold without participation felt worse than losing money. He realized he had protected himself from discomfort and accidentally excluded himself from opportunity at the same time. That recognition stayed with him longer than any losing streak. Around that time, Tyler began remembering how he approached challenges earlier in life. He had always relied on preparation to eliminate uncertainty. If exams were difficult, he studied more material. If a project carried risk, he planned every detail. Preparation reduced unknowns. Trading introduced an environment where preparation never erased uncertainty completely. Even perfect analysis could not guarantee outcome. That truth unsettled him more than he expected. His instinct was to keep refining until uncertainty disappeared. The market quietly showed him that certainty never arrives in the way he wanted. Waiting for it meant endless delay. He started noticing how frequently he checked his account during sessions, sometimes every few minutes. The numbers influenced his posture more than he admitted. A small profit created relaxation. A small loss tightened focus. Each fluctuation subtly changed his behavior. He saw how easily emotional temperature shifted based on temporary outcomes. The awareness felt uncomfortable. He had always considered himself rational. Watching those reactions unfold challenged that self-image. Intelligence had convinced him emotions played a minor role. Trading revealed how deeply feelings influenced timing and risk, even when logic sounded convincing. The story of Tyler during this period isn't about dramatic mistakes, it's about quiet erosion. Many traders imagine failure arrives through reckless behavior. His experience showed something else entirely. Slow inconsistency caused by internal negotiation. He followed rules most of the time, then slightly adjusted when discomfort appeared. Each adjustment seemed harmless alone. Over months, they prevented repetition from doing its work. Edge requires consistency long enough for probability to express itself. Constant refinement interrupted that process before results could accumulate. Eventually, Tyler stopped reviewing charts for a few evenings. Exhaustion forced distance more than intention. Without analysis filling every hour, something unexpected happened. His mind slowed down. He realized how tense he had been trying to solve trading like a riddle with a final answer. That expectation had quietly turned every session into an exam he felt required to pass. Exams reward perfection. Markets reward endurance. The difference mattered more than he initially understood. He began journaling differently during that break. Instead of cataloging setups, he described how decisions felt while making them. Restlessness before entries, relief after exits, urgency when price accelerated. Writing those observations revealed patterns he never noticed through technical review alone. He saw that impatience often appeared when he felt behind, compared to imaginary timelines. Confidence expanded after short winning streaks. Hesitation increased after missing opportunities. None of those reactions came from the strategy itself. They came from expectations about progress. Recognizing that didn't eliminate the feelings. It gave them shape. Once something has shape, it becomes easier to recognize in real time. During the following sessions, he noticed urges forming seconds before action. The urge to enter early felt familiar. The urge to widen risk felt predictable. Sometimes he still acted on them. Sometimes he paused long enough to let them pass. That pause felt small externally. Internally, it felt enormous. Trading slowly shifted from a problem he needed to solve into an environment observing him back. Tyler understood charts deeply. He began understanding himself with equal attention. The difference showed quietly. Fewer impulsive entries. Longer patience waiting for confirmation. Less attachment to explaining every outcome. None of these changes felt dramatic. They accumulated silently across sessions. And for the first time since he began trading, progress felt less connected to discovering new information and more connected to becoming steady enough to apply what he already knew. Chapter 4. Tyler expected the turning point to feel powerful. He imagined some clear internal breakthrough where everything suddenly clicked and discipline became effortless. What actually happened felt almost disappointingly ordinary. There was no surge of confidence, no dramatic winning streak announcing that he had figured it out. The change appeared in smaller moments, the kind most people overlook because they do not feel cinematic. One morning he opened his charts, reviewed his plan, and noticed an unfamiliar calm. Nothing exciting had happened overnight. He simply felt less urgency to prove anything. The charts looked the same as always. Price moved with the same unpredictability. His reaction felt different. Before this period, every session carried a quiet expectation. The day needed to justify his effort. A strong trade felt like confirmation he was progressing. A slow session felt like wasted time. That emotional accounting system shaped how long he stayed in trades and how quickly he abandoned patience. Now he found himself watching price move without the same internal commentary. He observed structure forming and dissolving without mentally arguing with it. Sometimes opportunities appeared and he executed. Sometimes nothing aligned and he closed the platform earlier than usual. Closing early once felt like defeat. Now it felt neutral. The absence of pressure surprised him more than any winning trade ever had. This stage revealed something uncomfortable. Tyler realized how much energy he previously spent negotiating with reality. He would enter trades hoping they behaved according to expectation. When price hesitated, he searched for explanations. When movement accelerated unexpectedly, he questioned whether he misunderstood something. Each reaction pulled attention away from execution toward interpretation. Intelligence encouraged interpretation because understanding had always been his strength. Markets required repetition more than interpretation. Repetition rarely feels intellectually stimulating. It feels repetitive because it is. Accepting that challenged the part of him that equated complexity with mastery. During this time, his results still moved unevenly. Some weeks ended green, others drifted sideways. The difference existed in what followed each outcome. He noticed losses closing without lingering tension. He journaled them quickly and moved forward. Earlier versions of himself would revisit charts repeatedly, searching for reasons that made outcomes feel justified. Now he focused on whether execution aligned with his framework. That question simplified review dramatically. If execution matched the plan, the trade joined the record and became part of the sample. If deviation appeared, he wrote it down clearly. The simplicity felt strange at first because it removed endless analysis loops. Tyler's single story continued shaping this transformation. Months earlier, losing trades felt like arguments he needed to win later. Now they resembled completed conversations. The distinction changed his behavior more than any indicator adjustment ever had. He stopped trying to recover emotional balance through additional trades. Sessions ended when conditions stopped aligning, rather than when feelings demanded resolution. That difference shortened some trading days significantly. Strangely, shorter days improved his focus. Fatigue decreased. Decision quality improved. He began noticing how often earlier mistakes occurred during extended sessions driven by restlessness rather than opportunity. Waiting became another unexpected teacher. Waiting had always felt passive to him. Intelligence prefers movement because movement feels productive. In trading, patience often appears indistinguishable from inactivity. Tyler used to fill quiet periods with research or chart scanning across dozens of instruments searching for something happening somewhere. That habit disappeared gradually. He watched fewer markets. He understood a smaller number more deeply. The slower pace felt uncomfortable during the first weeks. Silence revealed thoughts he used to outrun through activity. Doubt appeared. Impatience appeared. The urge to click simply to feel engaged appeared often. Recognizing those urges before acting became the real work. One afternoon illustrated this clearly. Price hovered near a level he had marked earlier. Nothing confirmed entry yet. Volume remained thin. Momentum lacked commitment. Old habits encouraged anticipation. He imagined the breakout happening without him. Missing moves had always bothered him deeply. He felt that familiar tightening in his chest. Instead of reacting immediately, he leaned back and waited. Minutes passed. The setup failed completely. Watching price reverse without involvement felt surprisingly relieving. That relief showed him how many previous losses began with anticipation rather than confirmation. The market had not changed. His tolerance for uncertainty had expanded slightly. Confidence started taking a quieter form. Earlier confidence depended on winning trades. Winning meant validation. Losing meant questioning everything. Now confidence resembled familiarity. He recognized common emotional patterns before they escalated. Fear still appeared occasionally. Excitement appeared during strong momentum moves. Doubt visited during slow markets. None of these feelings disappeared. They simply lost authority over action. That distinction mattered deeply. Emotional discipline stopped resembling emotional suppression. It became behavioral consistency despite internal movement. Tyler also noticed changes outside trading. Conversations felt slower. Decisions in daily life carried less urgency. Waiting in lines no longer irritated him the same way. These changes surprised him because he never intended trading to influence anything beyond markets. Repetition inside uncertainty trained awareness in subtle ways. He became more comfortable letting situations unfold without immediate intervention. That comfort transferred naturally into execution. Trading sessions felt less like battles requiring victory and more like environments requiring presence. Progress during this phase rarely impressed anyone externally. His account growth remained steady rather than explosive. Social media continued showcasing dramatic gains from other traders. Earlier comparisons would have created pressure. Now he recognized how little he actually knew about anyone else's process or risk. The comparison impulse faded slowly because attention stayed anchored to repetition. He understood that his job involved executing one trade at a time according to defined rules. Everything else existed outside his control. Accepting limits created unexpected freedom. The most important realization arrived quietly one evening while reviewing months of journal entries. Tyler noticed something undeniable. His strategy had barely changed since the beginning. His behavior had changed dramatically. Earlier entries described frustration, urgency, and constant searching. Recent entries described observation, patience, and fewer deviations. The system remained familiar. The executor evolved. Seeing that pattern in writing felt undeniable. Intelligence helped him build a framework. Emotional discipline allowed that framework to finally operate without interruption. He understood then why trading humbles intelligent people so deeply. Intelligence solves many problems through expansion. More ideas, more analysis, more complexity. Markets respond strongly to reduction. Fewer decisions, fewer reactions, fewer emotional negotiations. Simplicity demanded humility because it required trusting repetition without constant intellectual intervention. Tyler never stopped thinking deeply. He simply learned when thinking improved execution and when it quietly interfered with it. That distinction shaped the final stage of his transformation more than any strategy adjustment ever could. Chapter 5. By the time Tyler reached the final shift, it didn't feel like a breakthrough. It felt like a quiet acceptance of how trading actually works. He stopped expecting the market to reward effort immediately. He stopped expecting intelligence to protect him from randomness. He stopped expecting clarity before every decision. Instead, he focused on showing up the same way regardless of what happened the day before. That consistency became the real metric, not daily profit, not weekly returns. Consistency of behavior, consistency of risk, consistency of patience, consistency of execution. The account followed slowly, almost reluctantly, as if testing whether this steadiness would last. Earlier in his journey, every losing streak felt like a threat to identity. Now a losing streak felt like part of distribution. He still preferred winning days. He still felt the natural human response to drawdown. The difference existed in what happened next. There was no scramble to fix the weak, no surge of urgency to recover faster, no dramatic strategy overhaul. He reviewed trades, confirmed whether execution matched plan, adjusted only if structural flaws appeared. Then he returned to repetition. That repetition felt ordinary. Ordinary turned out to be powerful. Tyler also noticed how his relationship with winning evolved. In the beginning, winning created momentum that often turned reckless. Success felt intoxicating because it validated his intelligence. Now winning felt quieter. He logged profits with the same tone he logged losses. He avoided increasing size impulsively. He avoided adding extra trades simply because the session felt favorable. Emotional spikes in either direction lost their grip on behavior. That stability created smoother equity movement over time. Not dramatic curves, durable curves. Durable curves matter more than dramatic ones because they survive longer. The single story of Tyler illustrates something that many intelligent traders resist hearing. Intelligence is a tool for building structure. Discipline is the force that allows structure to function. One without the other produces frustration. When he relied only on intelligence, he constantly adjusted and refined. When he relied only on discipline without understanding, he would have lacked direction. The balance emerged when preparation happened outside emotional pressure and execution happened inside defined boundaries. His intelligence found its proper role in planning. His discipline found its proper role in repetition. Trading eventually stopped feeling like an exam. That shift changed everything. Exams reward perfection. Markets reward endurance. Exams test knowledge in controlled conditions. Markets test behavior in uncertain conditions. When Tyler treated each session like a verdict on his competence, pressure distorted execution. When he treated each session like practice within probability, pressure decreased. Practice invites repetition. Repetition builds familiarity. Familiarity builds calm. Calm improves decision quality more than excitement ever could. He still experienced difficult days. Certain sessions felt frustrating. Some weeks produced minimal progress. The difference lay in duration of reaction. Emotions passed through without defining the next decision. He recognized frustration quickly. He recognized boredom quickly. He recognized overconfidence quickly. Recognition shortened reaction time. That alone prevented many of the spirals that once defined his early months. He learned that mastery in trading does not mean eliminating emotion. It means recognizing emotion without allowing it to dictate execution. Over time, Tyler's results reflected his steadiness. Growth appeared gradually rather than explosively. That gradual growth felt satisfying in a different way. It felt earned through consistency rather than luck or momentum. He stopped searching for the hidden edge because he understood that his edge already existed within the framework he built months earlier. The missing component had always been behavioral stability. The market had never demanded greater intelligence. It demanded maturity under uncertainty. Looking back, Tyler recognized that the most painful phase of his journey had nothing to do with money. It centered on identity. Trading forced him to confront how tightly he connected competence with certainty. It forced him to accept that being capable does not mean controlling outcomes. It forced him to separate self-worth from daily results. Those lessons extended beyond markets. They reshaped how he approached risk in other areas of life. He became less reactive, less urgent, more deliberate. The same qualities that stabilized his trading began stabilizing decisions elsewhere. The transformation did not remove ambition. He still pursued growth. He still analyzed markets carefully. He still respected preparation. What changed was the absence of internal conflict during execution. The market stopped feeling like an opponent and began feeling like an environment. Environments don't need to be defeated. They need to be navigated. Navigation requires awareness and patience more than raw intellect. Tyler's intelligence finally served him fully once it stopped fighting the natural uncertainty of markets. If you identify with Tyler, understand that your intelligence is not the enemy. It simply requires direction. When it tries to eliminate uncertainty, frustration follows. When it builds structure and steps aside during execution, consistency grows. Trading humbles intelligent people because it removes the illusion that knowledge alone creates control. It replaces that illusion with a quieter truth. Behavior repeated consistently under uncertainty produces outcomes over time. That truth feels simple. Living it requires discipline. In the end, the market did not reward Tyler for being the smartest person in the room. It rewarded him for being the most stable version of himself day after day. Stability does not feel glamorous. It rarely attracts attention. It quietly compounds. And compounding, more than brilliance, is what ultimately builds lasting results.